Masterclass 14. Did you guys miss me? We had a little bit of a break between the last video, and I've got 4 more videos coming rapid fire after this one. Now, hopefully you've watched the 13 videos before this one in order. The idea is that you watch these videos in order, and then you can go back later if you need to kind of recap on something. And what I'm gonna focus on for this video and the next 4 videos is I'm gonna focus on more granular topics. In other words, we've got people that have gone through the Masterclass, yet I still get the same questions. And so I've come to the realization that there are a few topics that we can go a little deeper on. And one of those topics that I'm going to cover today is, when do you sell stocks? Not only if it's, say, Nvidia and you're up 1,000%, but what about those clunkers that you're down 20, 30, 50% or more on? What do you do with those stocks? Do you hold? Do you buy more? Do you sell? So this is one of the questions that I get over and over. When do I sell a stock? And for different reasons, to take profit or to cut your losers. Now in this video, I'll talk about 2 legendary investors, of course, Warren Buffett and Peter Lynch. It's important to understand that even legendary investors like these guys, 2 things: they make mistakes, but they're always learning. They're constantly learning. So if you're investing in a community like Fired Up Wealth, you are always learning. You're constantly learning, trying to improve. I've been investing for 25 years and I still learn and try to improve every single day. We're constantly in Discord, sharing information, due diligence, and so on. So what's my point with all this? Well, number 1, you're gonna make mistakes. Even the best investors in the world are gonna make mistakes. If you think about the market since the pandemic, it's really been an insane market. It's been an anomaly. It really was a black swan event, and it's created insane volatility and things that have happened that hopefully you never see again in your lifetime. So even investors like myself with lots of experience, we were throwing curveballs during the last few years, and we made mistakes, including myself. I made mistakes as well. And that second point is about learning all the time and improving. And so say you're a new investor, you started investing during the pandemic. You're obviously a better investor today than you were yesterday and a couple of years ago. So if you understand this, it's easy for you to look back and say, I might have bought a stock that I shouldn't have actually purchased. I didn't know how to research it properly. I didn't do my homework. I didn't do my due diligence. And sometimes you just have to admit you're wrong, swallow your pride, sell the stock, and move on and don't look back. And all of this comes back to psychology, which we've talked about previously in the Masterclass series, and we talk about in Discord every single day. Psychology and discipline, they're the 2 key things for long-term investors. And the more you understand about the broad picture and psychology and how all that interacts together, the better investor you'll be. And even though you're going to make mistakes, you're going to increase your odds of success by constantly improving yourself and learning by investing in yourself and being in a community like Fired Up Wealth. So with all that said in the introduction, let's break it down. Let's look at some reasons why you might sell a stock. So Masterclass on Stock Market Investing, Volume 14, when to sell stocks. There are going to be 12 key topics to consider. Selling could be a great decision, but make sure you're selling for the right reasons. So when to sell stocks. The bottom right of your screen, you're going to see 2 quotes from a legendary investor named Philip Fisher. The first quote: if the job has been correctly done when a common stock is purchased, the time to sell is almost never. So what's that telling you? Maybe you actually didn't do a good job when you purchased the stock in the first place. The second quote: the stock market is filled with individuals who know the price of everything but the value of nothing. Great example in 2021. A lot of these new IPOs and SPACs, nobody had any idea how to put a value on them. So remember, a share of a stock is ownership in a piece of a business. So if you buy a stock, you're buying part of a company. You got to make sure that you believe in that business. But with that said as well, think about this for a second. If you owned a plumbing business and all of a sudden you had seasonality and business slowed down, are you just going to go rush out and try to sell that business right away? Probably not. But with a stock, it's too easy. You push your button and it's sold. But try to think of it as you own part of a business, and is that business going to be successful in the period of time where you need the money next? Is the business broken or is the stock broken? And this is important. I would not sell a stock solely because of price action, either direction. Ask yourself the question before you sell. Why did you buy the stock in the first place? Does the stock still fit into your blueprint? More importantly, do you even have a blueprint? And the answer when you bought the stock is you probably didn't. Now that you found Fired Up Wealth, you know how to build a blueprint that meets your needs, your suitability, your goals, your risk tolerance, your DNA, and so on. So why did you buy the stock in the first place? Hopefully it wasn't for this reason.
Hello, I would like to purchase one stunken onion bot.
Okay. One stonk for onion bot.
Thank you. Now I simply wait and see my profits.
So me, man, basically buys a stock and just waits for his profits. Didn't do any homework, any due diligence, any research. You bought the stock, like me, man, you bought it because you thought it was going to go higher. That's the answer I get a lot when I have private conversations with people. Why did you buy the stock? Well, I thought it would go higher. What did you do any homework? Well, I watched a quick video on YouTube and it looked really interesting to me, but I didn't know much about it, but it looked good at the time. If that's your answer, you probably shouldn't have bought the stock in the first place. And you need to admit that. And if you can admit that, it'll be simpler for you to make the decision. Now, remember, as we go through this, selling a stock is going to be very individual, just like when you make your portfolio. I can't make the decision to sell for you. What I can do is I can empower you with this information, give you some examples and some things to consider when making your decision to either shave or liquidate a stock in your portfolio. Okay, so you've got some reds in your portfolio and you realize that you probably shouldn't have bought them in the first place. Now what? Go build a blueprint. You can watch these masterclass videos. Also go to the conference series. There's some great information how to build a portfolio blueprint. Now, when you build that blueprint, do not be biased to what you already own. In other words, don't take into consideration what you already own in your portfolio. Pretend like you own nothing and you're starting fresh. What would you build and what would you buy? After you've completed that, then cross-reference with what you already own and see if it actually fits into your blueprint. If it fits into your blueprint, that might make your decision really fast and simple. You might not have to sell. In fact, you may decide to even add shares and improve the cost basis, assuming that you didn't already go overweight on your initial allocation. The second thing to consider, has the story changed? This is a big one. Now be careful here. Did the story actually change or did the stock price just change? The stock being down again doesn't necessarily mean the story changed. A lot of times it does, but it doesn't have to. If the fundamentals have changed, you might consider selling the stock. What do I mean by that? Here are some examples. So the growth has slowed down and you don't see it accelerating again in the future. New management or leadership that does not align with your DNA. What does that mean exactly? Well, say you really like the CEO and that CEO left and you don't really like the new CEO and some of the rules and some of the policies that person's implementing. That could actually be a decision to sell a stock. You have to believe in the leadership. And this kind of piggybacks off that change in corporate culture that you feel will impact the long-term prospects or quality of the company. New competition has emerged, which has changed the landscape or maybe reduced the TAM, the total addressable market. The product or service has been disrupted by new technology or a competitor. And these are just a few examples to consider. So continuing with number 2 here, the story changed. How strong is the company? How strong is the company today? And what does it look like in the future? Is it overvalued? And more importantly, do you know how to value it in the first place? Remember that every single stock is going to be case by case. Different industries, sectors, they're all going to be valued a little bit differently. What do I mean by that? Well, a consumer staple is going to be valued differently than a hyper growth stock, a SaaS company, and you have to understand the metrics for each. Can it grow into its valuation quickly? So even if it is a little expensive, is it still growing and can it grow into that valuation quickly? If it's expensive and you actually see growth decelerating, slowing down, well, that might make your decision simple. Deterioration of fundamentals. Did these change? Did the margins drop? Did revenue growth slow down dramatically? If the fundamentals deteriorate, that could be a reason to sell a stock. Did debt increase substantially to add undesired risk? Now, there are many reasons for a company to add debt, and it could be good if it's a growth company and you think that this debt is actually going to help them grow more in the future. But maybe you didn't buy the stock for that reason, and it could create undesired risk. So debt is a consideration. And this is especially true if the company is not profitable. If you're investing in a speculative or a hyper growth type name that's not profitable yet, if they don't have free cash flow and they're burning cash and they're increasing debt, well, that could be a reason to sell the stock. Did an auditor's report shed new light on something new or something that you missed previously? So although the focus here is about the story changing, it's also possible that the story did not change, but you just missed something and you made a mistake. In other words, again, you might not have done enough due diligence and you might have missed red flags that were actually there. You just didn't know what you were looking for. You don't know what you don't know. This can happen, especially with new investors. And if you understand this, I think it makes it much simpler. You don't have to beat yourself up. It's okay. People do make mistakes. Even the best investors in the world. If you're a new investor, you got to cut yourself some slack. If your DD ability, so due diligence, your research abilities have improved and the company is no longer desirable, well, you might want to sell. Don't let your pride stop you. In other words, don't be like, I don't want to admit that I'm wrong. Eventually it's going to recover. If I hold it for 10 years, it's going to recover. That might be true, but don't let that be the only reason to bag hold. Number 3, acquisitions. And the first one here is going to be a cash deal. So once an acquisition is announced, the stock price of the company being acquired, it usually rises to a level close to what the agreed upon purchase price is going to be. And it usually doesn't get quite there, and it usually doesn't go over it. It gets just below it. So that means the additional upside potential is very limited. Oftentimes, locking in those gains and moving on with that cash to a new asset makes sense because it could take months for that deal to close and that stock price is just going to sit there flat. So recent example, this just happened. Know before, ticker KNBE. This is a company I was big on that does cybersecurity training. This company was purchased and taken private. So this is October 12th, 2022. Talking about know before, the price there, $24.90 a share. And so the stock popped 12.5% and it sat right under that $24.90. It was at $24.28 in pre-market. So what did I do? I went and sold my shares and I sold at $24.37. Made nice profit. It was still sad because I wanted to own this stock long term and I thought I could do good things. So February 1st, 2023, the deal went through, the acquisition was completed. And you could see it actually finalized at $24.90 per share in cash. So if I would have waited several more months, I could have got a few more cents per share. But instead I sold, I took that cash and I bought something else. In fact, I used that money to buy MongoDB and I'm up over 100% on that now. So again, filled at $24.37, the deal went through at $24.90. I left some money on the table, but I bought MongoDB and made over 100% return on that. Now, of course, there are risks to consider with this as well. If you don't sell the stock and the acquisition falls through, the stock could sell off and you might miss out on that. On the flip side of that, a competitive bid could come in higher and you could leave money on the table. For example, with Know Before, they had that deal at $24.90. So maybe another private equity firm came in at $27. Well, you could have lost a couple dollars a share and so on. And this is going to be case by case, just like anything that we talk about on this video. And smaller companies often have less regulatory issues. In other words, they're more likely to get approved versus like a large company like an Amazon trying to make an acquisition. So you have to have confidence that the deal is actually going to happen. And with Know Before, my confidence level was very high. Now let's talk about a different type of acquisition that deals with stocks. Now the first one we talked about was just cash only. It makes the decision much simpler. In this scenario, there's going to be stock or cash and stock, and you're going to have to look at that differently. So your decision to sell or hold will be based on whether you want to be a shareholder in the acquiring company. For example, Teladoc bought Livongo for $18.5 billion in cash and stock in late 2020. So if you owned Livongo, and I know several people that did who were very upset about this deal, you had to decide if you wanted to sell out or be a shareholder of Teladoc. Each transaction will vary. So in other words, every deal is going to be unique how it's structured. This specific deal was structured this way. So Teladoc, the largest virtual care company in the US, bought Livongo for $18.5 billion in cash and stock. Under the terms of the merger, Livongo shareholders received 0.5920 times shares of Teladoc plus cash of $11.33 for each Livongo share. And so this made it where Teladoc shareholders had about 58% ownership and Livongo 42%. And so some people that own, if you just own Livongo, you just sold it. Livongo shares popped, you sold out and said, I don't want anything to do with this. But this is just one example and it's going to be case by case and you're going to have to decide what you want to do. Number 4, do you need the money? Now going to the top 15 investing rules. Rule number 1, only invest money you can afford to lose. And what does that mean? Of course, it means if you need $20,000 to buy a new house in 6 months, don't take that 20 grand, stick it in the market and try to squeeze a few bucks out of it. That's risky. You don't want to do that. So in other words, you shouldn't be investing money that you need soon. But if you need the cash for some reason, sometimes it happens, you might have to make the tough decision to sell. Could be a medical emergency or whatever. Avoid this at all costs. I promise you, if you get comfortable with doing this, you're going to do it again and again, and it's going to impact your long-term performance and your ability to have financial freedom. But the point here is sometimes you don't have any other option and you have to sell for these reasons. Now I'll give you one example. The house I'm sitting in, I sold some shares of stock to buy this house. I needed money for a down payment. But when I sold my other house, that had equity and I got cash from that closing. And I took that cash and I put it right back into my portfolio once that deal was completed. So try to avoid it at all costs. If you end up doing it, just make sure you have a plan to try to replace it if you can. Number 5, rebalancing a portfolio. This is important and something we haven't talked about a whole lot yet. So what if your stock rips? So you own a stock that has provided significant outperformance. Your position may end up being overweight or over concentrated based on your desired blueprint allocation. Now I'm sitting on this example myself right now with Nvidia. I bought that stock in 2018 in the 30s and I've trimmed shares along the way. I'm sitting basically on house shares, but my desired allocation, I generally don't want to have more than 5% weight or concentration of any one stock in the portfolio and have to decide what to do next. Now, this is a high quality problem to have. You want these kind of problems in your life. You may choose to shave some profits to lower that concentration. But the problem is you have to decide when you're going to sell it. Like with Nvidia, do you sell it at 450? Is it going to go to 600, 700? Analyst price targets keep coming out 600, 700, 800. I've seen up to $1,200 per share. Now that's starting to get pretty outrageous because now you're talking about $2 trillion plus market cap. And so now you're going to have to try to decide. And of course, you can use some fundamentals and you can use some technicals, but sometimes it's very difficult when a stock has gone parabolic. And it's really tough because if you don't shave some shares and the stock drops, you're going to say, I wish I would have sold some shares. If you do sell and it goes up to $1,200, now you're kicking yourself for selling. So you have to be careful. And I want to share a legendary quote with you. Selling your winners and holding your losers is like cutting the flowers and watering the weeds. So this comes from Peter Lynch, One Up on Wall Street. You know by now, this is my favorite book of all time. And Peter Lynch is my favorite investor of all time. So in an interview with Forbes magazine as part of its 100 Greatest Business Minds series, Lynch said Buffett taught him to embrace what he calls his own greatest mistake, which was that he always sold stocks way too early. Again, a high quality problem to have, but this is really cool. So he recounts how Buffett called him unexpectedly on a Saturday night in 1989 to ask a favor. So when Lynch's daughter picked up the phone, she said, "It's Mr. Buffett on the line." So on this call, Buffett told Lynch that he loved his new book, One Up on Wall Street. And Buffett said to Lynch, "I want to use a line from it in my year-end report. I have to have it. Can I please use it?" And Peter Lynch said to Buffett, "Sure, what's the line?" The line that Warren Buffett wanted to quote was this: "Selling your winners and holding your losers is like cutting the flowers and watering the weeds." So rebalancing your portfolio. You might also sell to reduce exposure or decrease risk. For example, selling profits to convert into dividend-paying ETFs and blue chips for passive income. So as you approach your end game, you might be selling some of those profits and converting from growth to dividends. This transformation is going to take several years as you approach the end game. In other words, you're not just going to wake up on one Monday morning and say, "I'm just going to sell everything today and I'm going to go to dividends and SCHD ETF." This is going to be a transformation. It's going to be a metamorphosis. It's going to take you some time to transition into that end game phase. Greener grass. Be careful with this too, because the grass isn't always greener on the other side. But you might decide to sell a stock to replace it with another stock that you have higher conviction in. You don't have a lot of cash and you're like, "I don't really love that stock and I really want to own this stock. I'm going to sell this one and use the cash to buy this one." And oftentimes that probably is one of the better reasons that I've sold in the past. And I'll give you some examples here later. But a reminder again, be careful because stock price shouldn't be the only reason why you buy or sell a stock. Don't let the price action be the only determining factor. Use other data with your decision. And sometimes you're faced with tough decisions. So I'll share a couple stories with you here. So 2020, pandemic happens. Stocks drop hard. I had a combination of some growth, but I had a lot more dividend stocks at that time. I was really starting to transition more towards the end game. Now, when everything sold off hard, I'm looking at it saying, well, what's going to go up during the pandemic? And I started buying a lot of stocks that I thought could recover faster. So of course, technology stocks that really could be impacted and benefit from the pandemic. So a lot of those cloud names and things like that. And that ended up being a really good move. And I made a ton of money from that bottom move as we went into 2021. Now I did shave some profits in 2021, but admittedly I could have done a lot more. And so in 2022, what happened is now we faced a new bear market. And so I ended up selling stocks. Some were at a loss. A lot of them were actually for profits to reposition into higher conviction names. So some examples of that is I actually sold MongoDB in early 2022, ended up buying it back for lower in, the end of 2022. So I made profits on it, sold it, and then bought it back several months later at a lower price. I don't recommend normally doing that because it's timing the market. But in this situation, I looked at what was going on and I said, I don't have as much conviction in this right now, given the data I have, and I'd rather buy this other stock. There was a couple other stocks I wanted to buy, and I need to raise cash to buy those. And that's just one example. I sold a bunch of different stocks. I even sold the QQQ. And I tell you the story, I look at my QQQ as kind of like, well, I can always buy that back later. Sure, it could give me 20, 30% a year, but it's not going to be like some of these names that might give me 200% gains from those bottom bounces. So I actually liquidated all of my QQQ and took that, and I bought the highest conviction stocks, and I tried to concentrate. So I went from, I think, like 100 positions in the portfolio down to something like 60 positions. So I trimmed a bunch of positions and put that money into the highest conviction stocks that I could find, or the best prices I could find that I still had high conviction in. Examples like SciTime, Generac. There's a bunch of different names I was buying. I just thought the prices were attractive and I liked those stocks, and I kind of repositioned that capital. And of course, my situation is unique. If I've got a $1.5 million portfolio, I need $15,000 to have 1% to really move the needle at all. If you're just starting out and have a smaller portfolio, you're in that capital appreciation phase, you're getting paid every 2 weeks, it's a much different thing. So everything that we talk about here is very case by case. I'm just sharing some experiences from my past that, might help you understand a little bit better. That's all. Number 7, you're happy and valuation. These could be two separate ones, but you'll see here in a second. You may decide to trim or liquidate a stock if you feel you've squeezed enough juice from the orange. What does that mean? Well, for example, let's just say you bought a stock and you're thinking, well, maybe if I could get 100% gain in 3 years, 33%, I'll be happy. And instead of getting 100%, you got 500%. And it really blew the doors off any expectations you had for the stock when you first bought it. You might just be happy and say, hey, the stock could go higher, but I'm okay with the 500% gain. I'm going to sell it and move on. That could be a reason. Now, this goes on the other side of that, valuation. So I just talked about you're happy, valuation. Well, you could be happy still, but it could be the fact that the stock is dangerously overpriced, overvalued, frothy, parabolic. And usually what goes up hard has to come down. And you've seen that over and over again. And so when you know and you're confident that a stock is dangerously overvalued, frothy, parabolic, it's generally a good idea to trim some of those profits. And some people could even decide just to liquidate it altogether. And I have some examples back in 2021 where I did exactly that. And for example, you look at the whole Fastly Cloudflare story. You might have heard this before. I bought Fastly in the 20s, and all of a sudden it ripped up to $100 a share. I sold out of it. I'm like, there's no way it's worth $100 a share. I took that cash and then I bought Cloudflare for 35, 40 bucks in Discord. And so that was a really great move, because now if you look at Fastly, the thing's not worth very much at all. And so that was a situation where I knew it was dangerously overvalued. I understood the business. I knew it wasn't worth that much, and I just sold out, liquidated it, and moved on. Now, of course, I wasn't perfect and I didn't do that on every stock, but I just knew that business well enough to know it was not worth anything close to $100. And it went even much higher than that. And I was doing cash covered calls on it, and there's a whole long story behind it. So Nvidia, going back to this trimming, all right, so where do you sell it? Where do you trim it? Even though you're sitting on house shares, it's 10% of your portfolio, and it could have massive impacts if it drops hard. So I understand this company very well, and I have set prices where I'm going to trim it as it goes higher. At a certain point, it's going to get back down to 5% allocation. But with Nvidia, it's something I understand really well, and I have a good idea of where the stock price is going to go. And I'm certainly not just going to liquidate it here and leave money on the table. I think for a stock like this, at some, it's going to probably go higher, but at some point, it's going to have to come back down, find a new floor, and probably trade sideways. And you do have to be really careful with stocks when they make these aggressive moves, because a lot of people own shares at a lower price and they can sell it at any time. And once that selling starts, it can cause a chain reaction, a snowball effect, and it can really bring the price down. But generally, it's wise to trim some. And I do have a limit order in right now to trim some shares of Nvidia at a slightly higher price. And in some situations, like I mentioned with Fastly, you might decide to sell all the shares, liquidate it, and move on. Typically, it's not going to be just price that decides this. You have to look at other considerations as well. But there are times where the price is just so insane where it just doesn't make any sense, and you might just be happy, take your wins, your profits, and move on. But be careful cutting those flowers. Is it a weed that's disguised as a pretty flower, or is it actually a flower that's going to continue to grow? Number 8, something to consider here if you're looking to sell, cash covered calls, which we have talked about on the Masterclass series previously. Piggybacking off of number 7, let's say you're happy with the gains and you'd be comfortable selling at a higher price and be fine with gains at a specific strike price. You can use cash covered calls to reduce or liquidate positions while profiting benefiting from premiums in the process. An example, I just shared this with you in Discord. Nvidia, if I look at 2024 December cash covered calls, I can do one contract with a strike price of $950, make a $3,000 premium. And what that means is if the stock price goes to $950 or higher by December of 2024, I could lose those shares, but I still get the price for those shares. I still get $950 per share. And one contract is going to be 100 shares. So if I own, say, 250 shares of Nvidia, if I want to sell 100 shares and keep 150, I can do one contract, cash covered calls. If it doesn't get to $950, I keep that $3,000 premium and I keep all the shares. So people ask, what are the risks? The risks really just come down to opportunity cost. If the stock goes to $2,000, you're going to lose your shares at $950. Am I going to be crying about that? Not really. Now, some people might be, because you really, with that psychology and discipline, it can really mess with your head. When you make a decision to do a cash covered call, you have to be okay with the strike price no matter what happens. And if you're not, do not do it. And with this situation with cash covered calls, you're okay owning, but you're okay selling at a specific price. So I'm okay owning Nvidia, but if you want to take shares off my hands for $1,000 a share, I might sell some of them to you. Number 9, when to sell at a loss. Again, you're going to use previous considerations when making a decision to sell. As mentioned, do not sell a stock simply because the price went down. With that said, sometimes you have to cut your losses, admit that you're wrong, and move on. Now, you shouldn't sell simply because the stock price is down, but you also shouldn't sell it just because it's up. But also, Warren Buffett told us the most important thing to do if you find yourself in a hole, stop digging. What does that mean? That means don't keep throwing money trying to fix the cost basis. You're down 50% and say, well, if I double down, then I'll have a better cost basis and try to improve my cost basis that way. Don't get into that trap. Don't try to fix your cost basis by throwing more money at the problem. This is why you need a blueprint, and you have to use the cost basis. In other words, if you wanted 2% of a stock and that fit your blueprint, and you went out and bought 2% that fits your blueprint, and the stock goes down 50%, and now you'll have 1% actual, you have to use that 2% in cost basis. Don't just double down and say, well, now it's at 2%. Also, do not bag hold simply off of pride or hope. Don't be too proud to admit that you're wrong. And also, just don't hold a stock and just hope that it's going to go higher and not really understand if it can or not. The reason you bought the stock may no longer be applicable, or maybe you're just wrong about the company. It happens. Rule number 11, cut your losses. If a story changes and you lose confidence in the future outlook of a company, do not buy more. Cut your losses and move on. Repositioning capital quickly will allow you to recover faster. So you sold a stock and then you bought something that you thought was a better deal. The stock that you bought that you thought was a better deal went up 100%. The stock that you decided to sell actually kept going lower. If you held the stock and now instead of being down 50%, now you're down 80%. You took the loss, but you repositioned that capital and ended up being a much better decision longer term. And remember, Peter Lynch, in this business, if you're good, you're right 6 out of 10. You're never going to be right 9 times out of 10. The best investors in the world know that they're not going to be right every time. You're not going to be perfect. And you don't have to be successful and to achieve financial freedom. Number 10, tax loss harvesting. You may decide to sell at a loss to offset gains when taking profits to offset your taxes. This involves selling losers to help minimize or even eliminate your capital gains taxes. This is not the only reason to sell, but it could be a primary factor of why you decide to sell. Because if you have low conviction already and it's going to help you, with the tax situation, that's going to help influence your decision. All right, let's say, for example, that you sold one stock and you had a $1,000 profit, and you sold another stock and you lost $1,000. That could offset the tax liabilities. Basically, there's no taxes on that, and you raise cash from both of those sales. This depends on the type of account. Of course, it's going to be different if it's a retirement account versus a taxable brokerage. My primary taxable brokerage, my primary portfolio I talk about is a taxable brokerage. And you have to also keep in mind that different countries also have different tax laws. Additionally, and this is important, if you don't have investment gains to offset, or if you realize more losses than gains, you can use up to $3,000 in losses to reduce your ordinary income this year and every year thereafter until the entire loss is accounted for. But it's only $3,000 in losses in a year to reduce ordinary income. Now, if you're using losses to offset gains, there's no limitation on that within your portfolio. So you could, have $50,000 in profit and $50,000 in losses, and that would just equal each other out. This is talking when you don't have investment gains to offset. So let's look at an example here. So a hypothetical investor who realized that $10,000 in short-term capital gains and $15,000 in capital losses could use tax loss harvesting to reduce their tax bill this year and future years. So at the very top, short-term capital gains. So short-term is you own the stock less than a year, long-term a year or more. Short-term capital losses, $15,000. So $10,000 of capital losses used to offset $10,000 of capital gains. So $3,000 of losses in that green used to offset current ordinary income. And then $2,000 of losses used to offset future gains or ordinary income. So you can carry that $2,000 over next year for ordinary income, or you can use it against those future gains. Number 11, and this is really important to understand, the wash sale rule. If you're selling for a loss and plan to reinvest the cash, be careful of the wash sale rule. I see some people that are trying to basically sell a stock and then buy it back when it goes lower. You can really get in trouble if you screw this up. A lot of people did during the pandemic when they were day trading. They absolutely got hammered on their tax bills. You can't use the losses to offset gains if you purchase the same or substantially identical investment within 30 days before or after the sale. This is where people screw up because they think it's just 30 days after, but it's also before. So look at that infographic on the bottom right. You really have a 61-day total period. In fact, I would make it even longer than that. I try to be really cautious on here. I use like 3 extra days on both ends. And the reason for that is it takes a couple days to process, and you can actually get screwed if you mess that up. Individual stocks are pretty straightforward. ETFs can be a little bit trickier. In other words, if you sell a SPY and buy a VU, well, that's going to be an identical asset. Now, your brokerage, if you're using like Fidelity or something like that, they're going to do all this for you. So if you have a wash sale, they're actually going to show it to you on your tax statement. So this is really important. If you sell a specific individual stock at a loss, be careful. Let's just say you're using DCA and you added shares lower, say 20 days ago, and it kept going down. Then you sell an older lot at a higher price, but still at a loss. Well, you can't use those losses for tax harvesting. So just reading the infographic to kind of help explain it another way. A wash sale happens when you sell a stock or security for a loss and either buy it back within 30 days after the lost sale date or pre-rebuy shares within 30 days before selling your longer held shares. But just be really careful with this, because if you're using something like dollar cost averaging and then you make the decision, I changed my mind in this stock, something came out or some news came out, right? Something happened in the news that changed your mind, changed conviction, but you just bought some of this, a couple weeks ago. Now you go to sell it at a loss. Just be really careful with this wash sale rule. And again, your tax codes could vary by country. This is specifically for the US. So number 12, psychology and DCA, dollar cost averaging. Some of this is recap, but important here. Do not sell simply because the stock is up or down. Do not sell solely because of FUD, fear, uncertainty, and doubt, or any short-term concerns. This deals with timing the market, and that's a fool's game. So what does that mean? Well, everybody's talking about a recession. I'm going to liquidate my portfolio and then try to buy it back later. That could work out really well, but it's a huge risk, and generally speaking, it doesn't work out very well. I've been investing 25 years, and I've seen people try to time the market, and it never works. When everybody thinks the market's going to sell off, it usually doesn't, and vice versa. So we say timing the market, it's a fool's game. And that doesn't mean that you shouldn't be responsible with the management of your money, that you shouldn't hedge, that you shouldn't trim, have cash, and so on. It just means that if you're trying to be a long-term investor, you're not going to be able to just liquidate and try to move in and out of the market. It's not going to work out, especially when you think of tax ramifications and a ton of other reasons. If you choose to sell, never look back. Going back to psychology, this is huge, and I don't think many people can do this very well. If you sold Amazon in 2005, you're probably regretting every day of your life afterwards, and you're saying, why did I sell Amazon in 2005? I could have made X amount of money. If you make the decision to sell, you have to tell yourself, I can't look back. And honestly, when I sell a stock, I try to just avoid the stock altogether and just try to, avoid it. Now, with that said, that creates a bias. You have to be careful with that too. And that's one of my imperfections, one of my flaws. I pretend that a stock's kind of just dead to me. And I probably shouldn't do that, because maybe it changes and 2 years later, maybe I decide to buy the stock back and I can make a lot of money. But you just can't look back and say, I wish I woulda, coulda, shoulda. Don't do that. No shoulda, coulda, woulda. I'm going to share a Discord example example here. I did an open mic just a couple days ago, just joined the community channel, the community chat channel. And a few people came in there. We were having a discussion for 2-3 hours. And this person's from the UK, lovely lady. She said her employer, so she has a bunch of shares from her employer. And these shares have been flat for 10 years. And she's like, I wish I would have sold some sooner. What do I do now? If I sell them, then they're going to go higher. If I don't sell them, they're going to go lower. What do I do? This goes back to psychology. And really it depends too on the percentage of allocation. You know, if this is 10% of her net worth, she should have been selling some along the way. But I can't make the decision, you know, for this person because I don't know anything about her company or any of that, right? It's a very personal situation. But what I told her is if you do decide to sell, and I told her that compromise is always good, right? So she's like, do I sell all my shares or do I hold all my shares? Maybe the answer is somewhere in the middle. Maybe you sell half your shares and you hold the other half. But no matter what you decide to do not dwell on that past decision and don't look back. Because no matter what you do, it seems like it's going to be wrong. You sell, it's going to go higher. You know, you don't sell, it's going to go lower. When you make a decision, make that decision and don't look back. I want to talk briefly about this, DCA commissions, lot sizes. So not everybody has free commissions like in the United States. So I can just buy a fractional share or 1 share or 2 shares or whatever I want. If I'm in, for example, this person was in the UK and their brokerage, you know, has a hefty commission. It's a $20 commission on every transaction. Well, that person's not just going to buy $100 worth of a stock or 1 share at $100 when they're losing 20% on commission. And so they're going to have to stack up money and buy bigger lots, maybe $1,000 per lot and so on. So this is going to impact how you buy and sell. It's going to impact some of the psychology, just something for you to consider. In your country, again, we have a lot of international members, will have unique hurdles and unique tax laws to consider when you make your decisions. And a reminder again, different metrics are used for different companies. So a SaaS company is not going to be compared to Costco and so on. You get the idea. I'm going to wrap this up with a really powerful infographic here. So everything I just said, make sure you use this information when making decisions with your own money. But with that said, at a certain point, it's really hard to crawl out of that hole. And here's what I'm talking about. So look at the very top. Say you're down 5%. So you had $1,000. That's the starting balance or investment. You're down 5%. So it's worth $950. You only need a 5.26% gain to get back to par. Well, let's just look at say 40%. Well, now that $1,000 investment's worth $600. You're going to need a 66.67% gain to get back to par. That doesn't seem so bad. But as you get lower, it gets a lot harder. So if you're at say down 50%, that $1,000 investment, $500 is what it's worth right now. And it needs to go up 100% to get back to par. But go to the very bottom. Let's just say you have a $1,000 investment and it's down 95%. Now it's only worth $50. And that stock from $50 has to go up 1,900% just to get back to even. So at a certain point here, regardless of what your conviction is, sometimes it just makes sense, especially when you look at things like tax loss harvesting, just to move on. And hopefully you're not down 80, 90%. You've cut your losses before it got there, but sometimes it happens. And so if you're down 90, 95%, you know, you're really clinging on to a lot of hope because you're going to need a 10x or a 20x basically just to even break even. So that is something to consider when you're making the decision whether or not you should hold on to it, buy more shares, or sell. So if you got $1,000, you're down 95%. I mean, you're going to have to throw thousands of dollars just to improve that cost basis a little bit, and you're still going to have to dig yourself out of a hole, even with that said. And just be careful, again, trying to throw cash at the problem to fix the cost basis. Oftentimes that doesn't end well. So that's it for Masterclass 14. I hope this video was helpful. I've got more coming, so definitely stay tuned, guys. I appreciate your time and attention. I appreciate you being here. I appreciate your support. Have a great rest of your day. Take care.